Hello and welcome to the Finance Quarter. I'm Andrew Robertson. None of us know when we're going to die or if we'll become seriously ill or have a bad accident. And while we can't stop any of those things happening, we can stop them becoming a financial disaster for our families by being properly insured. But buying all the insurance we're told we need can be very expensive to the point where many people simply can't afford it. So what's the answer? I put that question to Sydney-based financial planner Tim Mackay. Tim, to properly protect our finances, financial planners tell us we need life insurance, income protection insurance, total and permanent disability insurance, trauma insurance, health insurance, and of course then there's home and contents insurance, car insurance, etc., etc. It all becomes very expensive, doesn't it?
It certainly can. And there's always a trade-off between what you can afford and the ideal level of insurance. And the trick is trying to find a happy medium between there. What we say to our clients is, in that situation, ask yourself 4 questions. Do I really need the insurance? How much do I need? Thirdly, how long do I need it for? Because you don't need it forever. And fourthly, which of those particular types do you need? And again, it is a trade-off and there's no magic answer. Each person's circumstances will determine the correct answer.
Well, notwithstanding what you've just said, if we look at, say, the average person in the average family, and not using the word average in a derogatory sense, what type of insurance do they need?
Okay, well, most people accept that they own their home. That's typically, most people think that's their biggest asset, so they'll have that covered. They'll have their car covered in case something happens to their car. Sadly, we know from the Victorian bushfires and the Brisbane floods that all too suddenly those sorts of assets can be lost. What a lot of people don't appreciate is that their biggest asset is potentially their ability to earn future income. And whilst we think of covering our health, a lot of us have health insurance, we'll take out health insurance, we don't always think that if we lost our ability to earn income, what would that do to our family situation? And it's two there. It's if you think about it, most couples will have a breadwinner and someone who manages the household, or they'll have 2 breadwinners. It's clear if there's 2 breadwinners, then covering both of those incomes could be appropriate. But even if someone's managing the household, if something happens to them, if they become sick or ill, then the person left behind has to pay for healthcare, pay for childcare for the children and to manage in the household, and B, they also want to work less because they want to spend more time with their family. So there are certain circumstances where individuals should certainly consider life insurance and other insurance products.
And what about income protection insurance and the other 2 insurances I mentioned, total and permanent disability and trauma insurance? Where do they fit into the mix?
We'll start with life insurance. Effectively it's death insurance, but if it was called death insurance, I don't think many people would buy it, but let's call it life insurance. That's a no-brainer. Effectively, if something happens to you or your spouse, then it pays out upon death. In a situation of TPD, effectively that covers you where potentially you become permanently disabled, permanently ill. In that situation, that payment will pay out. It will cover your medical expenses, it will cover your inability to earn income, so that can be quite important. The other one you mentioned was income protection. An income protection policy will cover you up to about 75% of your income should something happen to you. The benefit there, it can be tax deductible, so that can bring down the fees. Potentially it could be held in your superannuation, although that does have certain criteria and it has its own limitations. So they're the sorts of issues you should be considering when looking at those 3. Another insurance is trauma insurance, which covers you situations such as cancer and strokes. So they're the sort of 4 main types of life insurance.
So you're on a budget, and for many people these days it's a tight budget. Out of all the insurances we've discussed, if you have to choose, which insurance should you choose?
Again, I'd take a step back and say it's not what you can afford, it's what you need, right? So work out how much cover do you need. That's the starting point. For instance, if you've got a mortgage, the average Australian mortgage is around $300,000. You might need enough life insurance to cover paying off that mortgage, $300,000. If you've got ongoing expenses of $30,000, $40,000, you'll need enough life insurance to cover that. Get some quotes for those, shop around, get some quotes, and then you need to make a decision. Can I afford that full cover, or can I bring the cover down and reduce my premiums accordingly to a level that I can afford? So start from what you actually need and then work out how much you can afford.
And a point you touched on right at the beginning, as your life circumstances change, so your insurance needs will change.
It might not be appropriate for them. If you think back when life insurance was invented, it was never meant to be a permanent thing. It was only meant to be for young people as they were building their nest egg. They would need that cover. Once they built their nest egg, they no longer needed it. These days, there still exists an industry hell-bent on selling you as much as you can, as insurance as it can. However, as people age, as they start approaching retirement, then that need for insurance and the expense of that insurance, well, the expense goes up, but the need goes down. So be mindful that it's not something that you will have for the whole of your life.
Tim Mackay, thank you very much for that. Now, I know there's another topic that you're busting to talk about today, and we will talk about it, so don't go away, and we'll come back to you later in the program.
Great, thanks.
As the global financial crisis lurches from disaster to disaster, particularly in Europe, the International Monetary Fund has been making the headlines. Just the other week, it downgraded its outlook for world economic growth. But what is the International Monetary Fund and what does it do? Well, a man who knows is CommSec senior economist Savanth Sebastian.
Well, the International Monetary Fund is actually a conglomerate of 187 countries that contribute financially to try and help and foster economic growth. They look at such things as trade and exchange rates and really trying to ensure that if you do see a financial crisis, well, there's someone in there that can come in with a backstop. I guess what that means is it's each country's insurance policy. If things start to go wrong, there is a helping hand. And I guess the clear example at the moment is the European Union, and in particular what's taking place in Greece at the moment. Well, I guess the IMF has had a much more prominent role since the global financial crisis. We saw that countries saw their banking systems effectively freeze up, and the IMF has stepped in and thrown billions of dollars into those systems, trying to ensure that you see normal economic growth and that normal activity resumes. At the moment, the IMF is looking at throwing in a lot of dollars into the European Union to try and support activity, and I guess it even has ramifications domestically, because if you start seeing the banking system dry up globally, it will hurt the Australian banks as well. Well, speaking of Australia, Australia's contribution to the IMF is about $5 billion, about 1.3% of the total contribution from the 187 member nations. Now, that number may actually increase, and we may see Australia contributing almost double what it is currently. That's especially given the fact that the IMF is looking at creating a $1 trillion fund to support the European Union. Now, it sounds like a lot of money, but it's in Australia's best interest to ensure that the European Union remains strong and resilient, because it does have an impact domestically for Australia in terms of even the banks and what the cost of borrowing is. So a better European Union will ensure that Australia has a better future ahead as well.
Well, back here at Chatswood on Sydney's North Shore, financial planner Tim Mackay has kindly agreed to stay with us. And Tim, there's an issue that's really grabbed the attention of your profession at the moment, and that's the federal government's proposed opt-in for financial advice, where customers agree to continue receiving the advice, and more importantly, every 2 years they agree to continue paying for it. On the surface, that seems very reasonable, so why are so many financial planners against it?
I'm not sure, Andrew. I mean, to be honest, most professions work on an opt-in basis. If you think of doctors, lawyers, accountants, each year the client will approach them and seek their services. There is no automatic assumption that that professional will keep charging them without the client even deciding to opt into their services. So I'm a little bit unsure as to why our industry, which is evolving towards professionalism, has a problem with it. For a client to be asked every 2 years whether they want to be continuing with those services seems eminently reasonable to us.
So what's your understanding of how opt-in will work?
At the big picture level, as I said, it will be a requirement that the advisor asks that client every 2 years whether they want to retain those services. At the administrative level, the detail is yet to be spelt out. So for instance, whether a letter, a signed letter, whether a returned email, whether it's a returned SMS text will suffice. Those are the sorts of questions we need to drill down on to get to the bottom of that.
There are some people suggesting that this opt-in system will cost hundreds of millions of dollars to implement. To my untrained eye, I can't see that. Can you?
Well, to my trained eye, I can't see it either, to be honest. Financial planners already have systems in place to monitor, under the anti-money laundering and counter-terrorism financing requirements, to monitor a client's ongoing ID, which effectively expires every 2 or 3 years anyway. So to leverage off those existing systems to put a new system on top of that that monitors a client's ability to opt in to us, the marginal cost of that, there's no way that it can potentially come to those amounts that have been bandied around.
Even at its most formal, it would just be a standard form letter that you just bring out and put in front of a client, wouldn't it?
Exactly right. Now, for a start, if an advisor's not seeing that client every 2 years, I'd question as to what the service they're actually providing. B, even if they're not seeing them every 2 years, there could be legitimate reasons. The person could be travelling, they could be living long distances. To send a letter and to have that letter replied to within a 2 year period, again, seems reasonable to us.
Now, the cynics say that there'll be commissions lost and revenue lost. Have you seen any evidence of that?
I wouldn't say it's just cynics that say that. I'd say realists say that certainly will be the case. Lost commissions, lost revenues, certainly. That cost is a real cost. There will be a lot of business, passive business, or a transaction-based passive business where advisors perhaps saw someone a number of years ago and they're still retained or still receiving an income trail from that. That is not providing them a service. That is just bringing in a commission. If that ceases, that's good for professionalism of financial planning, and it's good for the consumers who are paying for a service they may not necessarily be receiving.
So is that the crux of the matter, that probably old-style financial planners who have a business built on trailing commissions can see those commissions disappearing and they don't like the future?
I think that's the elephant in the room that the industry perhaps doesn't like talking about too much. Certainly, I think they will suffer. I think those advisors who rely on that old commission-style structure will suffer, but advisors who have a relationship with their clients, who have a strong ongoing relationship, professional advisors, they'll benefit. It'll be great. It'll increase consumers' trust of our profession, and it will increase the professionalism of financial planning. It's win-win.
So in your view, opt-in will be good for customers?
And it'll be good for the professionalism of financial planning.
Tim Mackay, thank you very much for those insights.
Cheers, Andrew.
Opt-in is meant to start next year, but the debate, it seems, still has a long way to go. Well, that's all for this edition of the Finance Quarter. As always, if you'd like to watch any part of the program again, you can find us on the ABC News website. Just go to the business page and click on the Finance Quarter icon. And if you'd like to contact us, we're on Twitter at the address on your screen now, or you can drop us an email at thefinancequarter@your.abc.net.au. Thank you for watching, and we'll see you next time on the Finance Quarter.